Welcome to this series on systematic trading. In the previous episode, we looked at two types of risks and how they fare with respect to two types of position sizing. In this episode, we will compare the two types of position sizing with respect to risk-adjusted returns using a couple of strategies. So, hey, Aamodh, one of the things which we were talking about in the previous episode was two types of position sizing. So, fixed fractional and fixed lot size. So, in the sense, in one, we always trade, if we are trading two lots, we continue to trade two lots. But in fixed fractional, we take a percentage of the capital and we allocate capital based on that. So, these are the two approaches which we are talking about. We also noticed that when we trade fixed fractional, the risk is lesser than fixed lot size. Yes. That's something which we saw in the data. Now, my question to you is, because when we are talking, in the other episodes, we've talked about risk-adjusted return. So, if the risk in, let's say, fixed lot size is greater, does that give us greater returns? That is, risk-adjusted returns is what I would want to know.
Yeah, right. So the general tendency would be to believe that higher the risk, higher the return.
Correct.
But we would not want to believe it just like that, right? We would want to look at what data says, and only if data says that's the case, then we would like to believe that. So let's take a couple of examples of strategies.
Sure.
And compare the two styles of position sizing, fixed
Sure.
lot count versus fixed fractional risk.
Sure.
Right? So the first strategy is a 0DT short option time-based straddle. I'll just tell the rules.
Sure.
So you sell a short straddle at 9:30 a.m. in the morning on every 0DT day and place a 25% stop loss on the individual call and put legs.
Okay.
And if the stop loss does not hit, you exit it by 3:15 p.m., which is the day close. And you don't have any target, no trailing stop loss, nothing here. Just sell a straddle at 9:30 a.m., put 25% stop loss and leave it, right? So we'll try to backtest it for one lot backtest and see what the results are. So I'm specifically taking a example of 0DT only and not covering non-zero DTE days, because non-zero DTE days generally have lesser decay, which would mean that they have a lower expectancy in comparison to zero DTE strategies.
Sure.
So when we do a fixed fractional risk kind of position sizing, it automatically means that you're trading lesser number of lots on non-zero DTE days compared to zero DTE days, which might straight away tilt the result in favor of fixed fractional risk, which I want to avoid. I want to give fixed lot count a fair chance.
Got it.
So let's look at how the backtest results are. So what you see on the screen is the equity curve of a one lot backtest. So we are assuming a capital of something like notional capital of 1 crore. So you see 3% gain over 7 years window, which is very small. Ignore the gain. That's not the point of this video. You see a smooth looking upward trending equity curve, right? So let's keep it on one side. You can see the backtest results either in a pictorial form or in a tabulation form. This is the backtest result in the tabulation form. You have an expectancy of 0.42, which is quite high. You're trading just one lot. You have a Kalmar of 2.90, which is also good. So what you see here is a lot of lines. I'll explain what they are. At the top, you see a blue colored line curve.
Correct.
Which is essentially the premium, the straddle premium on each expiry day.
Okay.
Right. So it varies across different weeks, because depending on how much volatility is to be factored in, the premium is going to be proportionately high or low.
Got it. So just to get this right, so 300 rupees premium whenever that 2020 was, it means it's like call plus put was 300. Got it.
At the money call plus at the money put, the straddle premium is 300 points
at 9:30.
2020. Yes, at 9:30 a.m.
Okay.
You can see in recent times when the war-related instability was there, the premium has again shot up to something like 275 points on the expiry day. The red colored line in the same graph, where the maximum point is minus 75, is the 25% risk premium that we have per trade.
Got it.
When the straddle premium is 300, 25% of 300 is 75.
Got it.
So that's the risk per trade that you have on the straddle premium.
Okay.
As you can see, that again is proportional to the straddle premium on offer. On high premium days, your risk is more. On low premium days, your risk is less.
Correct.
The green colored chart is the realized profit or loss on that particular day. Depending on whether it was a profitable day or not, the green colored line would end up above zero or below zero.
Fair enough.
Right? So what you observe here is that on the day when the risk was maximum, which is 75 points, you had a profitable day. Right? In fixed lot count kind of position sizing, because you are sizing the same number of lots on all trades, all days, essentially your risk is highest on your highest premium days.
Correct.
And historically, for this strategy, fortunately, it has turned out that on the biggest risk days, it has come out to be profitable. Now, in future, it could be something else because the outcomes are very random in nature. And in future, on the biggest risk days, it could well come out to be lossy, depending on which the maximum drawdown that you see in future could be very much beyond maximum drawdown that you've seen in the past. Right? So I just want to point out so at the bottom of the screen, you have the drawdown curve, right? So the drawdown is maximum somewhere around 2024 November, right? And you see that there are three quite big risk days, one of which has been lossy, stop loss has hit, and the next two big risk days where your risk per trade is around 50 points, it has ended up in profit. Now, right at the time when you were in peak drawdown, the next two high risk days turned out to be profitable, which meant that the strategy came out of drawdown. Now, what if
it didn't?
It didn't, right? You end up having drawdown higher than historical max drawdown. So my point is that the sequence of outcome is quite random and you can't predict it. So the outcome is not in your control. What's in your control is how much you're willing to lose. With fixed lot count kind of position sizing, you cannot cap the risk per trade. With fixed fractional risk, you can cap it to, let's say, 0.2% per trade. So now let's go ahead and let's go ahead and do fixed fractional risk backtest, risking 0.2% of our capital per trade.
Okay.
On a notional account size of 1 crore, 0.2% comes out to be 20,000 rupees per lot, per trade.
Okay, so that's what you are willing to lose, 20,000 rupees per straddle.
Yes, per trade.
Yeah.
No matter how much premium is running that day on the straddle, you stand to lose only 20,000 rupees on your total capital, notional capital of 1 crore rupees.
Got it.
So let's look at how the backtest results are for fixed fractional backtest of 0.2% per trade. So this is how the equity curve looks like. Obviously, you wouldn't expect too much big difference if one lot backtest was a upward trending equity curve. Here also you would see the same.
Correct.
What you would want to compare now is the risk adjusted return.
Correct.
Whether it is better or worse when compared with fixed lot backtest. So let's look at the tabulation of the one lot backtest and the 0.2% fixed rupee risk per trade backtest side by side. You would observe two things here. So I would be taking two risk metrics and doing a comparison of risk adjusted return.
Sure.
The first risk metric is the max loss per trade.
Okay.
You see that in the one lot backtest, the max loss per trade is 0.04%. And in the 0.2% fixed fractional risk backtest, the max loss per trade is 0.25%.
That's because we capped it anyways.
Yes, we capped it anyways. And yeah. And the other thing is the max drawdown, obviously, in one lot backtest, it is lesser than fixed fractional risk backtest. So the key thing to know here is that in fixed fractional risk backtest, you're not trading the same number of lots all days. The lot count would be inversely proportional to the straddle premium on offer that day. So let's look at a graph which shows how much lots you traded per day, right? So as you can see, the number of lots you traded varies drastically across days, depending on how much premium was on offer that day. let's go back to the table of one lot and fixed fractional risk backtest.
Comparison.
Yes.
Okay.
So now what we would want to do is, when we want to compare the two against a certain risk parameter, we want to normalize it with respect to that risk parameter, size position accordingly, and then compare.
Okay.
So to normalize the risk in a fixed lot count backtest with respect to max loss per day, the number of lots traded should be 0.25 divided by 0.04, which is the max loss in a day in both the styles of backtest. That comes out to be around 6 lots. So if we traded 6 lots in fixed lot count style of backtest on all days, then the max loss per day in fixed lot count style backtest would be same as fixed fractional risk 0.2% backtest. Right. So now let's look at how the backtest result for a 6 lot fixed lot count backtest looks like, and stack it up against the 0.2% fixed fractional risk backtest. So this is how it looks like. As you can see, highlighted in blue is the max loss, which is comparable now between the fixed fractional risk and fixed lot count style of position sizing. You would also note that the Kalmar between a 1 lot backtest and a 6 lot backtest has not changed, because Kalmar is independent of how many lots you trade.
Correct.
And so is expectancy. Expectancy again is a function of your average reward to risk and your win rate. Neither of it changes with the number of lots you trade, so it still remains the same. The standout difference between the 0.2% risk per trade backtest and the 6 lot count fixed lot count backtest is the total profit. You see a big difference between between the two backtests when it comes to total profit.
Got it.
Let's look at it visually. As you can see, there is a gigantic difference between the returns between a fixed fractional risk backtest and fixed lot count backtest. This is after normalizing with respect to the risk per trade. Huge difference. So we can kind of conclude that the risk-adjusted return in a fixed fractional risk backtest is much higher than fixed lot count backtest when you normalize with respect to the risk per trade.
So this is very interesting, Aamodh. So I have a question. So we are talking about fixed fractional risk, which means on days where the premiums are high, we are sizing smaller. On days when premiums are low, we are sizing bigger. So which of these two segments contributes more to this overall P&L, because where we are seeing this difference of 35% versus let's say 16%?
So let's go back to the graph of how the premium varies over multiple expiries. So as you can see in the graph, you hardly get a few days when the premium is extremely high.
Got it.
Right? So majority of the days is when premium is quite low.
Interesting. Right? Got it.
So the fixed fractional risk outperforms fixed lot count kind of position sizing, because in low premium days it sizes up big. Now you might ask, why not size up big in fixed lot count as well? But if you size up big in fixed lot count, then during high premium regimes, if a loss happens or a sequence of loss happens, then you run the risk of big drawdown, which would not exist in a fixed fractional risk kind of position sizing.
Makes sense. Because most of the days it's not going to be high premium. It's, it'll be mid to low premiums is what majority of the days will be. Makes sense. And those days we are sizing bigger. Got it.
That's right. So now we looked at how the equity curves of the two styles of position sizing look like when we size with respect to normalizing with respect to max loss per trade.
Got it.
Now let's normalize with respect to drawdown risk and see how the equity curves compare. So now let's look at how the backtest result for a fixed lot count kind of position sizing when we normalize the size with respect to the max drawdown.
Okay, how do we do that?
So you can see that the max drawdown in a 1 lot backtest is 0.14%, and in the fixed fractional risk backtest, the max drawdown is 1.16%. Now you divide 1.16 divided by 0.14, you get 8. When you round it off, you get 8. So you would be sizing fixed lot count by 8 lots per trades to match the backtest, match the drawdown of the fixed fractional risk backtest.
Fair enough. So last time when we kind of normalized it with max loss, it came out to 6 lots.
Yes.
This time we are normalizing it with max drawdown and we are getting 8 lots.
Yes,
Fair enough.
that's right. So you would be trading 8 lots all trades in the fixed lot count back test, which would give you a drawdown of around 1.1%. It is almost same as 1.16%, which you saw in the 0.2%. There's a slight difference because of granularity when rounding off the lot count. Now, as you can see, the ratio, which Kalmar ratio, which is the ratio of return to max drawdown, is 4.4 in the fixed fractional risk and only 2.9 in the fixed lot count kind of position size.
Got it.
This is essentially the risk adjusted return with respect to drawdown risk.
Correct.
It's much higher in the fixed fractional risk backtest. And you look at the total profit again is much higher in the fixed fractional risk backtest when compared with the fixed lot count backtest normalized with respect to drawdown risk. Let's look at the equity curve of this backtest pictorially.
Yeah, so we're seeing all the three now.
So this is how the backtest result, the equity curve of the backtest result looks like for the three variants that we have backtested. The blue color one, which has given the highest return, is that of 0.2% fixed fractional risk. The green color one, which is in the middle, is that of when we adjust the when we normalize position sizing with respect to the drawdown risk. And the red colored one is when we fixed lot count backtest when we normalize position size with respect to max loss per trade.
Got it. So in a way, if I have to look at these three charts, the red line is 6 lots, the green line is 8 lots, and the blue line is varying based on the premium. Got it.
The max loss per trade is the same between the red line and the blue line. The max drawdown is the same between the green line and the blue line.
Perfect.
So fixed fractional risk has in general tended to give much better risk adjusted returns, at least for this strategy, when compared to fixed lot count kind of position sizing.
Sure.
I'll just show the tabulation of whatever we discussed till now. So what we see now on the screen is a compilation of whatever we have discussed thus far with this strategy for different styles of position sizing adjusted with respect to different risk.
Correct.
You see that as we saw pictorially, the returns is highest in the risk adjusted return is highest in fixed fractional risk kind of position sizing. Now it looks like all metrics are in favor of fixed fractional risk kind of position sizing. Are there any demerits with respect to this kind of position sizing? So to answer that, we'll answer this question a little later, but before that we'll look at another strategy and compare the fixed lot count and fixed fractional risk position sizing.
Okay. So we're doing the same thing on a different strategy to see whether this is strategy dependent or not.
Yes, that's right. So the first strategy that we talked about is the short option strategy, intraday short option strategy. Now we are going to take a intraday long option strategy and do the same analysis and see how it fared.
Sure.
How fixed lot count versus fixed fractional risk fared in this strategy.
Is this a range breakout strategy?
Yes, it's a range breakout strategy. Intraday range breakout long option
strategy. Got it.
Let's get into the rules of the strategy. So these are the entry and exit rules of strategy 2 that we're talking about. It's a 9:16 to 11:15 a.m. range breakout.
Okay.
And the strike selection would be whatever strike has premium of 200 at 9:16 a.m.
Okay.
We put a 20% stop loss on the entry premium. We exit it at 3:15 p.m. if no stop loss is hit. Just like any of the strategies that we've discussed thus far, this has no trailing stop loss, no target profit. And the position sizing for a fixed lot count kind of position sizing, we are trading 1 lot per 1.5 lakh of capital.
And we run this all days?
Yes, we run it all days. This is not a zero DT strategy. This is all days strategy. We assume an account size of, let's say, 75 lakh, which means that divide 75 lakh divided by 1.5 lakh, you would be trading 50 lots on 75 lakh of capital. We do the same methodology as we did in the strategy 1. We normalize with respect to the risk per trade and see how the equity curve fares between the fixed fractional risk kind of position sizing and fixed lot count kind of position sizing.
Sure.
This is how the equity curves look like. Here for the fixed fractional risk backtest, we have taken risk per trade as 1% and risk per day would be 2% because if both call and put side long option trade got triggered and hit stop loss, that would cost us 2% risk per day. So as you can see, the blue line, which is the fixed fractional risk kind of position sizing, when has given higher risk adjusted return when you normalize it against the max loss in a given trade in the fixed lot count kind of position sizing. Let's look at it in a tabulation form just to reinforce whatever we have observed in the graph.
Sure.
So as you can see, the first column is the one lot backtest where the max loss per day has been historically 7.67% of the capital. But when we and max drawdown, you see it's like 45%, which is on the borderline untradable.
Correct.
And it has a maximum losing streak of 9 days. The fixed fractional risk, when you risk 1% per trade, which is 2% per day, you can see that the max loss per day is limited to 2%, 2.04%. And the maximum drawdown drops down to 16.64%. And the annual return now is 27%. Earlier it was 72%, now it's 27%, obviously, but the risk also has reduced. You compare the Kalmar ratio, it is almost the same. Nothing much has changed there. So we don't want to do the activity of normalizing with respect to drawdown risk there. Because the Kalmar ratio anyways is the same. Now, fixed fractional risk backtest, you have a max loss of 2%. In one lot backtest, you have a max loss of 7.67%. You would want to downsize the one lot per 1.5 lakh kind of backtest by a factor of 7.67 divided by 2.04 would come out to be 3.76. Let's round it off to 4 lots.
Okay.
And column 3 here, you see the results for a 4 lot backtest.
Got it.
Right? Or it's not a 4 lot backtest. You are basically in the 1 lot per 1.5 lakh kind of fixed lot count backtest. You are sizing 50 lots all trades. Now you divide 50 divided by 3.76 and round it off. That many number of lots you would be trading in the risk per trade normalized fixed lot count backtest.
Got it. So yeah, so when we are looking at this table, can you tell me how many lots in each?
Yeah, so in the column 1, which is 1 lot per 1.5 lakh kind of sizing, you're trading 50 lots all trades.
Okay.
In column 2, which is fixed fractional risk kind of sizing, it's different number of lots each days. In the third column, we are trading 50 lots divided by 3.76, which comes out to be around 13 lots.
Okay.
So that's the number of lots we trade.
But it's still a fixed lot size.
Yes, it's still a fixed lot size, lot count kind of backtest.
Got it.
So as you can see, the returns are much higher in fixed fractional risk backtest. The risk adjusted return is much higher in fixed fractional risk backtest compared to the fixed lot count backtest.
So when we talk about the risk adjusted return over here, which are the rows should I be comparing?
Yeah, so you want to be looking at the row which has max daily loss.
Okay.
Earlier in the fixed lot count kind of position sizing, when you traded 50 lots all trades, it was 7.67%.
Got it.
Now in column 3, you look at the max daily loss row, it is now down to 2%, which is the same as the fixed fractional risk.
Correct. So more or less the daily loss percentage is fixed because we normalized it.
Yes.
But the returns in fixed fractional is greater. Considerably greater.
Yes, considerably greater.
So that tells us that from a risk adjusted standpoint, fixed fractional risk again wins.
Yes,
got it. Right. Got it. So we come back to the same conclusion. So are you saying that come what may, use fixed fractional risk as a way to position size, or there is something that I'm missing?
Yeah. So the thing is, until now, the two strategies that we have taken into consideration are all intraday strategies. And in intraday strategies, you have a good amount of determinism when it comes to the exit levels. The odds of exiting at the intended exit level is much higher in intraday trading when compared with the positional trading strategy.
Where there is a gap risk
Yes.
and we cannot
Yes.
account for it.
There is an adverse gap risk, then we cannot really exit it at our intended levels. So that's where the point is. So fixed fractional risk is a better option to go with for intraday strategies, in my opinion. But when you're trading positionally, short options, then you want to look at another risk metric, which I consider as the final boss of the risk metrics, which is value at risk. So let's take an example of a particular day and try to figure out what exactly I mean.
Okay.
Right? So as a positional trader, you need to be looking at value at risk as a very important metric while sizing position. And for that, fixed lot count kind of position sizing makes sense, where you size something like, the net contract value of your position should not exceed 1x of your account size or any factor of your account size. That's the better way to size position.
So since you are talking about value at risk, can you simplify, and explain what exactly value at risk means?
Yeah. So value at risk is just, I don't want to get into the technical terms, but in pure English language, if I have to tell, value at risk is the maximum amount of rupees you can lose in a given trade if a huge adverse gap happens and you're not able to exit it at your intended levels.
Got it.
So let's say you have sold a straddle, you have bought some hedges which are something like 500 points away. In Nifty, let's say you have sold a 22,000 straddle and bought 22,500 call as hedge and 21,500 put as hedge, and you're sizing one lot. Then let's say 1,000-point adverse gap happens and you leave this position till expiry. Then you stand to lose 500 points on one side, and you tend to make whatever premium, the net credit that has happened on the other side, you tend to gain it. So your value at risk would be essentially the 500 points you lost on one side and whatever you gained on the other side. So value at risk essentially is what's your maximum possible risk if you are not able to exit your position at all and leave it till expiry.
Got it. So now we were talking about value at risk in the context of positional strategy. And that's the reason you suggest that, a fixed fractional approach may not be ideal for positional, but it works in intraday. Now, another question in the context of intraday. Now, what happens to this concept of value at risk on an intraday time frame? Why shouldn't I be looking at it there?
So ideally, you should be looking at value at risk in intraday time frame as well. That's something I do. Let's take an example of a particular event that happened in the past and see how things went there. Right. So on the screen, you look at the graph of 24th February 2021.
So, that was the day where, NSE stopped sometime in the afternoon, if I remember.
Yes. So until around 10 a.m., 10:30 a.m., the trading was happening as usual, and later prices stopped updating, and by 11 a.m., the market was closed. NSE, because of some technical glitch in the NSE exchange, the market was closed. And at that point, no one knew at what point the market would open. So people who had taken an intraday position, assuming that they'll be able to exit at their pre-intended levels, would be left wondering, at what level would they be able to exit. Now, suppose when this market was closed, some bad event happened, maybe war started, and when the market opened, there was a 10% adverse gap. How much would you lose? Right. So if you went with fixed fractional risk kind of position sizing without hedging, then you run the risk of theoretically infinite value at risk. Right. So it's very important to hedge your position and cap your value at risk, even if you are trading intraday. So value at risk is best capped when you know how many lots you are trading, right? So with the fixed lot count kind of position sizing, because you know the number of lots you are trading, there's determinism around that. You can select your hedges accordingly to cap the value at risk at a particular level. Now with fixed fractional risk kind of position sizing, you can still cap your value at risk to a defined level, just that you will have to dynamically move your hedges far or near, depending on how many lots you trade, and cap your value at risk at a particular level.
So you mean you suggest having hedges even for intraday to
Yes.
take care of value at risk there.
Yes, that's right.
Got it.
So especially if you are doing fixed fractional risk kind of position sizing, because you'll be trading huge number of lots when the premium is low, you definitely want to hedge your positions even for intraday.
Got it. So since we are talking about hedges for intraday trades,
Yeah.
since you use fixed fractional method of sizing,
Yes.
and I'm assuming you also take care of value at risk by hedging.
Yes.
So have there been instances of particular days where hedges saved you?
Yes, there have been instances. An example was May 13th, 2024.
Mhm.
It was a Monday, mid-cap Nifty expiry day. And so I was running my intraday 0DT short option positions with extremely high leverage. I like to manage my risk to the maximum extent possible and size up as much as possible to increase the returns. So what happened that day is markets were in a kind of downward trend until something like 10:30 a.m. The straddle premium was priced around 64, which is quite low. And then suddenly in the second half, the market moved up big. Coincidentally, that was a day when I was away from my screen because of some personal commitments. And so at the end of the day, when I looked at my MTM, so I trade a non-directional system on 0DT days, which means that if a big move happens, ideally I would end up at a loss because non-directional systems are meant to benefit from non-directional days. But coincidentally, on this day, when I looked at my MTM at the end of the day, it was very good profit. The reason is that I always hedge more than 1x on my hedges. If I'm selling one lot, then I hedge 1.2x times that lot. If I'm trading 10 lots, I'd be hedging 12 lots. So what that meant is that my short option positions hit stop loss and market moved up huge. And the mid-cap Nifty premiums that I bought at around 0.5 premium, they ended at 50 premium. So hedges saved me that day. Even for intraday trading, it's very important to hedge. The problem is not about how much you make out of those hedges. What if the short option position that I had missed stop loss due to limit price protection, stop loss order rejection, and market continued to move up? Then you are essentially, what that means is you have infinite risk on your short option position. Unless you hedge, you don't cap the risk. And by hedging more than 1x, if market moves beyond those hedge strikes, you end up, benefiting out of it. So yeah, so that's what I do, and it helped me that day.
Cool. So Aamodh, so what we understood out of this whole conversation about position sizing is, as far as intraday strategies are concerned, fixed fractional works great for risk-adjusted returns.
Yes.
At the same time, you should not forget the value at risk, and that's where hedging comes in.
Yes.
And as far as positional strategies are concerned, your fixed lot size is better because that takes care of value at risk because it's fixed lot size. Is that correct?
Yes, that's right. You have determinism around at what strike you want to hedge, and also you have better determinism around the hedge cost involved.
Got it. Cool. So that brings me to the end of this episode on position sizing. In the next episode, we will look at a few things which generally don't get talked about. Things like holding period, its impact, a few psychological nuances, how that affects trading, and all of that.